Hello traders, my name is Frank Paul, one of the mentors at forexmentor.com. I would just like to welcome you to this latest Saturday public video presentation we make available to members and non-members alike of the Fibonacci Swing Trade Service. Today's presentation is titled Reading Market Structure Top-Down. I mean, isn't that the most basic skill that you need in order to be able to find trades? I think so, and we're going to cover that off. Now, the particular twist that I have on this is that, as you've probably gleaned by now watching these Saturday presentations over the past several weeks or possibly longer, we use a method called the swing point triple screen. And to make a long story short, that means adapting Dr. Alexander Elder's triple screen concept, making use of swing points aligned on 3 consecutive time frames. That adaptation is unique. Dr. Elder uses a particular indicator. We're not using indicators for that purpose. We're using market structure itself. Okay, so swing point analysis, market structure, market flow, all of that stuff goes hand in hand. And it's really the most important skill to develop first as a trader, to give you that trading bias day by day, especially if you're a day trader or a scalper. You need to know which way the wind is blowing. Is it blowing up or down? If it's not blowing either way, you're in the horse latitude somewhere, then you don't put up your sails. You wait for the wind to come back. But what we're doing here is trying to establish a tradable direction and then look for the dips in the uptrend, rallies in the downtrend to enable us to execute a trade. And that's really the basic concept I wanted to go over here today. All right, the particular situation I'd like you to consider is as follows. Even within an entrenched trend reading, viewable, let's say, on the weekly and or monthly charts, you can run into retracements of some significance. That's not new information for you by now. You're probably quite aware of that. The trend could be down over a multi-month or even multi-year period, but you can see a move of some significance, some duration in the opposite direction, which does not have the effect of changing that high-level trend, although it may change your trading bias if you're trading short-term. And by short-term, I mean basically anything less than a position trade. Okay, so the questions in that particular situation that no doubt cross your mind are as follows. Firstly, how do you anticipate a retracement? In order to trade intelligently, you have to be able to anticipate price action, right? Either you're in an uptrend and it's going to continue going up, or you're in a downtrend, it's going to continue going down. Here we're talking about a short-term change, not so much in the trend, but in the tradable direction. Okay, so how do you anticipate a larger retracement? Let's see one that you would find on the daily chart. Okay, then it's normal to ask, well, how do I know that that change is only corrective and not an outright trend reversal? If I see a bounce off a low and price covers several hundreds pips, apparently with a lot of gusto behind the move, how do I know that the trend is not suddenly up where it was down before? How do I know that that move is only corrective and therefore entailing a change in my trading style, looking not for longer term trades but probably shorter term trades, looking to book profit more frequently because by definition retracements are more difficult to trade. Okay, how do I anticipate it? How do I know it's only corrective? Another question to ask is, how do I respond to it? Do I trade it or do I sit it out? I think the simple answer to the question of whether to trade counter trend is, what scale of counter trend move is it? Okay, if the intraday trend is down, but you get a short little rally sequence on the 5-minute chart alone, that's probably not worth chasing from a reward to risk perspective. But certainly a retracement on a higher time frame, which seems to reflect a preceding move of some duration, that might be worth trading because the pips potential is more significant. The time and price distance to be covered is more substantial, so that's the short of it. If we find a retracement on the daily chart, we can certainly think about trading it. It just, again, entails perhaps a change of strategy. If you're used to swing trading or position trading, maybe you have to think about day trading only if you're going to do anything with it. If not, yeah, maybe you do have to sit it out. If you only position trade, you probably don't want to position trade a retracement. And finally, if you're going to commit to the trade, how do you enter, manage, and exit the counter trend trade? Okay, it's easy to talk about scaling down, but what does that actually look like? Where do you go in terms of the time frames? How do you line up an entry signal? What kind of exit strategy do you think about? Okay, so these are all questions that hopefully will at least do some justice to today. We're going to use a chart illustration making use of the Euro-US pair, which last week kind of quote-unquote bottomed out before starting to rally pretty sharply. And so we'll try to answer all 4 of these questions in relation to that chart illustration.